Welcome back. Let's talk about markets. Devang Mehta, the head of equity advisory at Centrum Wealth Management, is now with us on the show. Devang, for the last couple of days, it's been all about these sugar and fertilizer names where we are seeing the maximum momentum and excitement. Any thoughts on these two spaces?
Afternoon, Rima. I think what is happening is probably market is taking a pause. We have seen globally also sort of a little bit of volatility again creeping back after the Fed stance was a bit hawkish, and we saw a lot of central banks sort of raising rates and still scared about inflation. And also on the other side, it's also a scare about recession, which is sort of driving the market trends at this point of time. So I think India, after a smart rally, is getting into hibernation mode where consolidation can happen in the larger names. As such, a lot of nifty stocks, a lot of companies which are frontline have rallied a little too ahead of expectations. I think the second leg of the market rally is going to be driven by companies which have been laggards, companies which have not done very well, but they've opened up in terms of earnings opening up or cyclicality. Deep. A lot of these companies which we discussed about fertilizers as well as sugar had gone through a deep period of cyclical pain. I think those companies are coming back. The market breadth as such is not bad. A lot of companies in the mid-cap, small-cap universe and companies in the sectors which have not done well is coming out. So particularly view on fertilizers as well as sugar is a little different for us. We generally don't chase this type of businesses for clients who are long-term. Yes, for shorter-term, medium-term, there seems to be a trend which is emerging in this type of companies. But pure play long-term, we would be more positive on something like agrochemicals, specialty chemicals, which also go through cyclicality. But there is a lot more money to be made as China plus one, Russia plus one theme plays out, and India gets into that competitive edge period as well.
Hi Devang, good morning. You were just mentioning that, a lot of these stocks actually ran ahead of themselves and perhaps are now correcting. Take us through which ones you're referring to here. Are you talking about the banks?
Yeah, Pavitra, I think banks had a big period of underperformance. Let's be very clear. A lot private banks started to rally first. The likes of ICICI, the likes of Axis, they rallied first, and post that, a lot of PSU banks also. There was a 10-year underperformance clearly on SBI. If you look at the last 10-year returns for SBI, hardly the last 1.5 years has been where money has been made in this company. So somebody who waits on these businesses for the next 3-5 years, it's a difficult proposition when your companies do well. You sort of want to buy companies which do well. So you feel left out. The sense one gets here is if somebody has a 3-5 year horizon and is focusing more on compounded annual growth rate or IRR, still private banks are the place to go. But yes, for the 6-month, 1 year period when your NPAs are all out of the system, when your NIMs are going to expand, you can't lose out also on certain PSU banks. And that's the trade which is getting taken at this point. Autos had underperformed. Most of the auto and auto ancillary stocks have also started to come to the fore and do well. And as the first question was regarding fertilizers, a lot of PSUs, a lot of sugar companies, all this had a long period of underperformance, including power stocks as well. So most of these companies are sort of getting maybe some fundamental cushion ahead, and some are a rally of laggards which we are looking at this point of time.
So your top 3 bets for the first half of 2023, Devang?
I think on a sector perspective, yes, I'll give certain examples as well. But on the sector perspective, typically your banks look exceedingly well. Banks look very good. Particularly ICICI and Axis Bank, of course, these companies had rallied, but over the last 2-3 months, most of these companies have consolidated. I think the management commentaries for the coming quarter, the January quarter, is when the domestic earnings season will start. And again, most of the management commentaries will point out towards consumption probably expanding. Discretionary was good. Non-discretionary started to see some bit of green shoots. Capex is also on the rise, and credit growth is also going to come back to the banking system, which is around 17-18%. So my sense is you can't miss out on banks. Top private banks will be the first pick. Second is discretionary consumption, luxury consumption. Companies like Titan also seem to be probably consolidating in the last 3-6 months. They also can sort of come up with good set of numbers, being festive demand, being wedding demand. I think all this will also come to the fore. Importantly, one sector which we have been always bullish at the expense of being repetitive is home improvement or sort of building materials, where we are also seeing crude coming down drastically from say 130, 120 to sub 85, sub 80 in the last 1 month. Very importantly, most of these companies had inventories, and that's why the last quarter numbers were not so good. So maybe this quarter or next quarter, the numbers would start to improve drastically, and margins will also show a good bit of expansion. So my sense is that somebody want to play a 1-2 year theme in consumption, in building materials as a real estate cycle, a proxy play for paints, adhesives, electrical goods would do very well.
All right, got that. And would you directly play the real estate companies, by the way, since we're talking about home improvement?
I think some of them look interesting, but as I said, a direct play on them would be a little risky because we know that how much they book in a quarter, that's always a little volatile game to play. But most of the proxy plays or the ancillary play, you are very certain that these companies would have a strong cash flow. A lot of these companies would also have a negative working capital cycle. Most of these companies show pricing power. So I think that part is a little more attractive to us than getting into real estate, direct real estate.